Hi friends, welcome back to Moneycraft. I am CA Pritish Burton and we are back again with another interesting topic on stock markets, that is futures and options. Friends, I hope you have watched my video on basics of stock markets. We are staying with the stock markets, but we are going one step further in this video, that is about futures and options. Futures and options are basically derivatives. They are financial instruments, but they are called derivatives. In order to understand derivatives better, we need to look back into history. The first ever derivative transaction was in the year 600 BC. We all have heard about the famous mathematician and Greek philosopher by name Thales. He entered into a contract with the owners of the olive oil presses or mills in the city of Miletus. The contract was to buy the exclusive right of use of all the oil mills in the city after harvest. Since the contract was made in winter, there was absolutely no way to understand how good the harvest of olives would be. So in that case, he got the contract at a very lower price. The owners of the oil mills thought, in case if the harvest is bad, this is a good way to protect themselves from the losses that they would incur. Luckily for Thales, the harvest was very good and he made huge profits by renting out the oil mills. This is how derivatives work. Just like we had in the case of oil mills, it is possible for you to bet on the future. So when you bet on the future of a particular asset, that itself is derivatives. So in simple terms, derivatives is a financial instrument which derives its value from the underlying assets. Just like how we have shares and bonds as a financial instruments, derivatives also is a financial instrument. But it does not have its value on its own. It derives its value from the underlying assets. In the previous case, it was olive oil. So the derivatives could be anything starting from stocks, bonds, interest rates, currencies, commodities like gold, silver, and many more. Today in the markets, we have two important types of derivatives. One is futures and the other one is options. So friends, let us first begin with futures. A futures contract is an agreement between two parties where they come together to buy and sell a specified quantity of a particular asset at a predetermined price on a particular or a fixed date in the future. Simple example, Reliance Futures. In case of Reliance Futures, it is a derivative contract which does not have its value on its own but derives its value from Reliance stock or the share price. As I already said, in case of derivatives, you are betting on the future. In case of Reliance, you enter into a contract, a future contract, expecting that the prices will go up from 2000 rupees to 2200 rupees. So you enter into a future contract at the rate of 2000. Now as you expected, the price of Reliance share has gone up by rupees 200 and you end up making profit of rupees 200 per share. Normally in the stock market, we can buy even one share. But in the case of derivatives market, we cannot do that. In case of futures, we need to buy the shares in lots. In case of Reliance, the lot size is 250. You cannot buy one share, but a minimum buy of 250 quantity. But let us look at the other side. What if the stock prices of Reliance fall? In case if it falls by rupees 100 for example, then you would lose 250 quantity into 100 per share. 25,000 rupees would be your loss. The second type of derivative, that is options. The name itself suggests that it gives you the option, which means that you get the right but not the obligation to buy or sell the particular stock at a certain price on a predetermined or a fixed date in the future. Coming back to our Reliance example. Now you have bought an option thinking that the price will go up, but the price comes down. So you have the option not to exercise the contract. So what will be your loss in this case? It is the option premium that you are going to pay. So the option premium is the price that the traders pay to enter into an options contract. Now there are two types of options. One is the call option and the second one is the put option. So when is call option used? A call option is bought when the investors think that the price of a particular stock will go up and they sell the call when they expect that the prices to come down. So it gives the buyer the right and not the obligation to buy the asset at a particular price. Investors buy the put option when they expect that the prices will come down and they sell the put option when they expect that the prices will go up. So the put option gives the buyer of the put the right and not the obligation to sell the asset at a particular price on a fixed date. In case if you didn't understand or got confused with the options, do not worry because this itself calls for a separate video on this subject. So I'll be making a separate video which will give you a clear understanding of put and call options. Now why derivatives or why futures and options? So as I already mentioned, in case of futures, it is only with the margins that you can take the trade, whereas in the case of options, you can only pay a minimum amount of premium and then enter into the contract. So which is not in the case of the cash market or the stock market in which we trade on a daily basis. So now the next important question is whether you need to wait till the end of that predetermined date or a fixed date that we were talking about. The answer is no. So in order to understand that, we need to understand what is expiry date. So in case of futures, future contracts expire every last Thursday of a month. If the last Thursday is a holiday, then in that case, it is the last Wednesday of that month. In case of options also, the expiry is on the last Thursday of every month, but only in case of Nifty options, it is weekly expiry, that every Thursday it expires. So the options and the futures contract are not for the unlimited period, but based on this monthly or 2 monthly or the 3 monthly contract. So coming back to the Reliance example, you have bought a Reliance future expecting that the Reliance prices will go up. So you need not wait till the end of the expiry period, but in case if the prices go up after 2 or 3 days, you can exit the contract right away and book your profits. Now, how do you start trading in futures and options? The answer is simple. You use your Demat account which you are using for buying and selling of shares. The same one can be used also for futures and options. Now, a very important point that I would like to stress here is that consider your risk appetite. In case if your risk appetite is very low, then do not venture into futures and options because it could be a riskier business. So do your homework properly and then only enter into futures and options. Now coming to the last point and the most important point. Because I have noticed many people who are salaried and then they trade in futures and options. They declare their profits or losses from trading in shares, but they do not do in case of futures and options, which could trigger the income tax notices. The profits that you gain from trading in derivatives, that is futures and options, are considered as business income and not capital gains. So friends, this is a very basic video on futures and options. In the future, we'll be doing more videos on futures and options. Stay tuned and thanks for watching. Many more interesting videos on the way. Happy investing.